Hey guys, it's Matt. We're going to do a skeptical review video here. The thing that caught my eye on this one is 20 years back tested, it says in the title. That piques my interest.
It's trade.
Before we jump in, I just want to let you know that I watched this video originally probably 6 weeks ago, and then I back tested the strategy and did some tweaks and things, and I have some data to share. So what I'm going to do is just watch the video now because, to be honest, I don't really remember much about it. And I'll kind of give my initial thoughts and impressions as we go through it, and then we'll jump into the back test. All right, let's go.
Today I'm going to show you a trading strategy that is just scary accurate. It's called the OR, the O.
Okay, really quick, he said accurate. That's just, I literally don't remember anything about this video, so I'm just pointing this out. Accurate to me just means that it has a high win rate. That doesn't necessarily make it a good strategy. It doesn't make it a profitable strategy. It just means it has a high win rate. So we'll see though. I'm nitpicking right here in the first 3 seconds of the video.
Opening range reversal. It's simple, it's repeatable, but best of all, it is really hard to mess this thing up. And that's because all you need to do in order to master this strategy is wait for one candlestick to form, draw yourself a horizontal line, then wait for the entry. I mean, that's all there is to it. But don't let its simplicity fool you, because when done correctly, it is hard to beat the power and accuracy of the opening range reversal.
Okay, so this is the typical pitch that you get for a strategy, right? It's simple, it's repeatable, and it's profitable. Okay.
This isn't anything like it. And that's because it takes advantage of one specific nuance that has to happen every day in financial markets. Now I'm going to show you what that nuance is here in just a moment. But before I do that, let me take a moment to introduce myself. My name is Doug, and I've been in the trading game since we've had dial-up internet. It's been a while. And throughout that time, I've studied hundreds upon hundreds of different trading strategies. And I have never seen anything close to the power and accuracy of the opening range reversal. So what I'm going to
I wonder how many strategies this person, I don't know this guy, Doug, I wonder how many strategies he's actually studied. Because hundreds upon hundreds is a fuck ton of strategies. I doubt it's really that much, but all right, opening range reversal. Let's take a look.
So for today's example, you'll see in the upper corner, just for reference, I'm using the stock ARM, ticker symbol ARM. It does not matter what's up here in this corner. This could be gold, oil, some other commodity, it could be some cryptocurrency, it could be futures, doesn't make a difference. I just happen to be using the stock today.
Okay, so this works on everything. Interesting.
If you are not using the daily chart on a day-to-day basis for all of your trades, no matter what strategies you're using, you are missing out on a very big critical piece of context. And all the professional traders will always tell you, if you don't like the daily, you don't like the intraday either. And that's very, very important to understand because the daily chart holds keys and secrets that we need to make great trades.
It's actually likely really good advice, just understanding the market environment on our broader context, either daily or even weekly charts. Just to get the, again, broader market and also the specific stock that you're looking at, how has it been performing for quite some time. Yeah, that's good advice.
Whoever controls the daily, whether that's bulls or bears, will ultimately, in most cases, they will win out on a day-to-day basis. Let me show you what I'm talking about right here on the screen. If we go back to our chart at ARM, I now have the daily chart selected up here in the corner. Now, most of the time, you will be able to use common sense, and you can see, if I was to ask you what was the price action or what was the trend over the last few months, well, that's pretty simple. You can see this with your eyes, that over the last few months, ARM has gone up in a very steady trend. So that's obvious. The trend is up, meaning bulls are in control. That's the trend bias. Now,
okay, I hope he quantifies this right here, just in some way, shape, or form, because it's really important for a strategy. Because at what point along that trend do you recognize it's a trend? 5 days into it, 15 days into it, right? I'm just throwing this out there before he gets there, but I hope he quantifies it in some way. Okay, cool. He quantified it. It's actually a really simple way. I like that. Okay, those were some really obviously cherry-picked examples, but the overall message, I think, is still valid. At least I feel it is. So it's good. I don't know this guy's background, but it seems strange to me that an institution that wants to accumulate more shares of ARM and already has a position, you would assume, at a lower entry, would sell that entry to get more shares at a higher entry rather than just adding over time in some way. It's interesting that he's saying that that's manipulation. The way he's saying it makes it sound like he's sure that anytime the opening range is more than 20% of ATR, that it's manipulation. But he's just, what I think he means to say is that he's using that as a guideline, I would imagine.
In that range. That right there is manipulation. So what perhaps to newer traders may look like fear, because that's what it's designed to do, or where you may think, oh, I'm catching a falling knife, you're not. You're under a manipulation move that is going to be reversed. So what I'm going to do here in this part is combine number 3 and steps number 4 together. Number 3 has
This is just semantics, but I would like, I apologize, Doug, for just pausing the video on that face you're making. But I would like him to say that the move is likely to be reversed, or is reversed a certain percentage of the time, rather than is going to be reversed, because not every time, right? Nothing's true every time in the market. So I'm nitpicking his words, but I think it's an important message to get across, especially to new traders. I might have missed this, but did we quantify how long into the open we're waiting for this to happen? Is there a cutoff point? Did we mention that yet? That's something I want to be on the lookout for. There's not a chance that was 50%. There's no way that this profit target is 50% between here and all the way down here. His entry is probably a little, I would say 50% somewhere in this range right here. Anyway, I'm nitpicking, but we should be. This is your money. Nitpick. Candlesticks don't really tell you anything. The fact that one candle moves above a previous candle, you can use that as a trigger just to simplify your system or your idea, but the broader market doesn't give a shit about candlesticks. And you can just look at it. He's using the 5-minute time frame. He said you could use any intraday time frame, right? So you could use 15 minutes. Well, then your entry would look completely different on a 15-minute time frame. What about a 2-minute time frame? In a 2-minute time frame, maybe you'd get that break of the previous high much sooner than he was here. So I don't love the way he's talking about that and saying like, oh, it confirms that the manipulation is over and now the real trend's kicking in. I don't buy it. I still think it could be a possibly useful strategy. I just don't buy the explanation.
Following that process, we're not talking about some chart voodoo here where we're drawing lines and just trying to guess. This is a solid strategy with a high accuracy rate that can really help you start to put some good trades together.
Okay, so we've got like less than 2 minutes, in fact, just over a minute and 15 seconds left of this video. He's said that it has high accuracy twice. So far, I haven't seen any statistics on win rate, profitability. I mean, any statistics, expectancy. Yeah, I haven't seen anything, right? We haven't seen any statistics, and I'm waiting for a 20-year back test.
All right, my friends, that will conclude today's video, and as always, it is a pleasure to share my strategies and knowledge with you that I've...
Okay, I stopped that at an opportune time. I promise you that was not planned. Oi, well, I'll let him run out the rest. So one thing I will say is he's a great presenter, and the video is really well done. I mean, he's got a cool background and good lighting and all that stuff. It's funny. So just at the end there, he was talking about his, I don't know what he called it, stock picker thing, right? He's telling you which stocks to get into, which is funny because this disclaimer at the beginning basically says he's not a financial advisor, but he just did say, I tell you which stocks to get into, where to get into them, and where to exit. I think I'm paraphrasing, but it also just at the bottom there. These are standard disclaimers, but his results are not typical. They are based on over 25 years of trading experience. So interesting stuff here, guys. There was no back test at all, not even an attempt to show you a back test or any kind of statistics on what this strategy does over time or has done over time. So let's take a look at that. All right, guys, a few things to discuss before we dive into the actual data. Basically, there were some things I had to quantify because they weren't quantified in the video in any way. So one, what is the opening range? Are we talking about a 5-minute opening range, 15 minutes, 30 minutes? Does that part matter? What constitutes a worthy initial move? What he calls the sucker step in the video. And maybe that is what you use as your guide for the opening range, as long as that initial move, in his case, the 20% ATR rule, right? So as long as you're at 20% or more of the 14-day ATR from the opening range high to the opening range low, that's enough, right? It doesn't matter whether that happens in the first 5 minutes or first 20 minutes, maybe, but there has to be a cutoff at some point where it's not the opening range anymore, right? If you hit that 20% or more, 3 hours into the session, are you still taking that as an opening range reversal? Probably not, right? So we have to quantify that in some way, put a rule around that. And then also, what about a certain excursion below or above, depending on whether you're long or short? But let's just talk about longs for now. What about a certain excursion below the open? Obviously, you have to be below the open in order for it to be a long reversal. If you're 1 cent below the open, does that count as enough of a downward excursion to want to play a reversal off of that? Considering that you must have hit the 20% rule at that point, that means you had to go pretty high above the open probably before you reversed and now are 1 cent below the open. So there's just some things that weren't discussed. It was because he showed obvious examples, right? Where it was like, oh yeah, that's obvious, a downtrend off of the open. There were like 3 red candles. So, okay, yeah, they're playing a reversal off of that. But the market doesn't always look like that. It looks a lot dirtier than that sometimes. So also, what basket of stocks does this apply to? Does it just apply to SPY and Qs? Does it apply to the Magnificent Seven or the entire S&P 500? How do we know what stocks to apply this to? Also, using the 50-day moving average as your trend indicator, well, how far above or below the 50-day does the stock have to be in order for it to be a trend? Is there a certain excursion above that? Again, for longing, is there a certain excursion above that you need to meet? So these are things we had to quantify. By we, I mean me and my dog. So what I did next is I ran a multivariable backtest over almost 10 years with the following criteria. The PCT threshold and PCT upper that's the percent difference from the 50 daily moving average. By the way, I only tested longs in this case, just to kind of see if there was, if there was enough smoke here to think there might be fire. This is all just for long scenario, and we can do short scenario later if anyone cares. So PCT threshold, that's the lower bound. So that's like, okay, the price needs to be at least, the open price of the day needs to be at least this far away from the 50 simple moving average in order for it to count. And then the upper bound is, okay, it can't be any further than this away from the 50, right? So it sets a range. The ATR minimum, that's just, I'm trying to weed out small range stocks, so 75 cents of ATR, average ATR daily. Volume in, that's just the 30-day volume average of either 2, 4, or 6 million. The excursion percentage is the amount below the open, right? So that is, from the open, it's got to go at least 1% below the open for it to count as a lower excursion that you can play a reversal off of. The ATR, that is just the thing that Doug said in the video, where it has to be at least 20% of the 14-day ATR. I didn't change that. I did test that a few times. I tested, well, what if it's a little less, what's a little more? It didn't really make a difference. So we just left it at 20%. And then I tested different profit targets. So Doug's profit target of like halfway between the opening range high and opening range low, the 50% mark. I tested that early, and honestly, it just wasn't all that impressive. So I changed the way I would do profit taking. Wherever your entry is, the low of the opening range was still the stop, and then I just based the profit target off of that range. So it's either 1, 3, or 5R, being that the entry to stop is 1R, right? And then you also see a break even. So either no break even stop at all, or break even after 1R. Okay, here's the fun stuff. So again, when I do a multivariable back test like this, it tests, if you haven't seen one of these before, it tests every variable with every other variable combination. So in this case, that's 72 different back tests. And the data goes back basically 10 years from now, which is late September. Yeah, we'll take a look at this top run here. But basically, so each line here is one of the back tests, and it's just a summary of the back test, the criteria that were used, and then the outcomes. So you can see the criteria here. These are the things we just went over. I don't know how much you'll be able to see them, but the PCT threshold, lower and upper, the ATR minimum, that's always 0.75. This is the volume in. So you can see all of that. I don't need to read all of it. And then here is where it starts to pump back the outcome. So this one had 2,833 trades. Yeah, I'm not going to read all these stats, right? The win rate was about 35%. You can see average win, average loss. That's calculated on, the dollar figures here are calculated on starting with a $25,000 account and risking 1% per trade. And then
No ending! No ending! No ending! No ending!
Here you have the average win and average loss based on R multiples. So you can see the average win was 2.1, 2.2 R if you round, and then 0.9 or almost 1 R loss, which makes sense. The expectancy is 0.11, which is not terrible, but not like a home run. One thing I didn't do in this back test, I didn't calculate Sharpe ratio or Sartino or anything like that, so I don't have that. I can, if somebody really wants it, I guess I can add it. Or you could do your own damn back test, and you'd probably be better off that way anyway. So this is expectancy in dollar amount. This is the total R over all of the trades. So remember, 1R is 1% of the account, right, at any given time. So that's 325 total R over the time period. You can see the total P&L and the final balance. The final balance is 174,141. So you took your account from 25,000 to 174,000 in about, we'll call it 9 to 10 years, somewhere in that ballpark. Just taking a quick glance here, you can see there's a couple that, or at least one that was a little better than that total P&L wise, but it's just kind of the way it works out. And then max drawdown in dollar amount, 51,000 max drawdown there, and it's a 55 to, you can see the top couple here, anywhere from 50 to 65%. It's pretty big max drawdown. So you can see what I like to do is just kind of like, okay, I have these, I should say, I have these sorted by expectancy. So the one we're looking at here at the top is the greatest expectancy in terms of R. You can see like the top few here, we're looking at, you know, the lower bound really is kind of a mixed bag there between the 1% and 0.1%. And then the upper bound is mostly the 3% upper bound. I did more testing than this initially, guys. These are, I kind of whittled it down to these. Basically, I found that the farther you got away from the 50 moving average, the less successful this became. Which kind of makes sense, because the farther you get away from a moving average like that, the more likely you are maybe to start reverting to the mean, which means if you make that downward move initially, it's not likely to go back up because it's reverting back to the mean, right? It's so you've got your distance between the 50. So there really was kind of like a, man, if you're right above the 50 in a trending stock in some way, I'm guessing, yeah, that means you're probably going to try to create some space there. So the reversal is more likely to happen, and you're more likely to make a good bullish play there, right? Whereas the farther you get away from that 50, the more likely you are to just pull back toward it. You can see the volume kind of all over the place too. This is a lower bound for the average volume, right? But really culling the list by taking out the low volume stocks didn't really do much. The excursion didn't change, the ATR didn't change. The take profits and the break evens are the one thing that, so you can see here, really holding for the at least 3R, maybe the 5R take profit, and not moving your stop to break even seems to be the way to go. What I did then was I took this top row, the criteria for that made this top row happen, and I just did a single run of that, and this spits out then all of each individual trade, right? So you can see we got the beginning around December 2015. So I used the entire S&P 500 for this, which, you know, there might be a better way to do that, right? You might be able to, find a different way to whittle down which stocks you would use. But just be careful of the backward-looking bias there, right? Like, don't be like, well, what about if we just use the Magnificent Seven? It's like, yeah, but you didn't know in 2015 that the Mag 7 was going to be the Mag 7 yet, probably, right? You just have to be careful about, like, okay, well, pretending that you're future dumb in December of 2015, how would you decide which stocks to use? Using the S&P 500 is a pretty good way, I think, to get started on, all right, where do we start from, right? So anyway, you can look through these. Yeah, this is what real backtests look like, guys. It looks just like a bunch of numbers. So you can see all the way down to the most recent one was VST on the 29th, which was yesterday at the time of recording this part of the video. And then there's the total balance of $174,140.95. You can I'll upload these to my Google Drive and put links in the description there so that you can look through these if you want. But let's take a really quick look at maybe these last two trades. Okay, let's take a look at this VST trade first. I've got a 5-minute chart pulled up for the 29th. The opening candle is right here. I believe you hit your 20% ATR right off the bat, and our entry ends up being right here. So you can see this does not look like the nice example of having a fade. If you start back here, yeah, it looks like a nice little fade. But this is the opening candle, right? So there's no like, oh, 3 red candles and then it reverses and all of a sudden it hits my target. This is a little uglier, but still it meets the criteria, right? You've got your 20% ATR, you hit that pretty early. You've got a lower candle here, and then this candle actually clips the high here, and so you would enter on this candle. The entry is like 202.31, I think, in the back test. Yes, 202.31. So you can see the initial stop was 198.26, and the target was 222. And then the exit ended up being 198.4, which was the end of day. I stopped out at like 3:30 Eastern time. So you can see this candle here is the 3:30 or 3:50 candle, and so that ends up actually being 3:55 because it's at the close of that candle. So you can see the close there is 198.41, and so 1 cent of slippage I think I had worked into this. So 198.40 was our exit. Let's take a look at UAL. Okay, this one looks a little bit nicer off the bat, right? It's got a nice fade right here. This is the opening candle. Then you've got a couple other red candles there, and then my guess is, I haven't looked at the numbers yet, but I'm guessing our entry is going to be around 97.72. Okay, there you go. So 97.72. The stop is 97.14, and our exit is 97.13. You can see because rather than doing the magical, hey, look at this, it's a great opening range reversal, it rolls over and stops us out right here on this candle. Overall thoughts, guys, is it profitable? Technically, yes, it didn't lose money. You could also add the short side to this. I just wanted to back test the long side first and see if it was like really an incredible strategy. I'm not feeling it, but I don't know, maybe the short side is just where all the mega bucks flow in. I don't know, but I wanted to show what it looks like when you watch a YouTube video and they say there's a back test. There wasn't anything even resembling a back test, except I've been doing this for 3 decades, and so trust me, because it made me a bunch of money without any verifiable evidence at all about how much money was made with this particular strategy or how much money was made trading stocks at all. I don't know anything about this guy, but when you actually look into it and do the back test, you'll find the numbers are often not as flashy as they're made out to be, which is the case here. So anyway, if you liked this, guys, if you like these kind of back tests, do the YouTube stuff, like, subscribe, all of that, comment, share. Sharing would be great. Yeah, I'm just trying to get this stuff out there, guys, trying to get people to do their own back tests and figure it out. Anyway, good luck out there. We'll see you next time.
Let's trade.
If you're 1 cent below the ocean, oh yeah, below the ocean. Don't even give him a whack fuck here.